Hey everyone, and welcome back to the show. Today, I'm very excited to introduce our guest for the day, Richard Canfield. Richard, welcome to the show.
Hey, excited to be here, Suja. Thanks for having me on, and pleasure to be with you and your audience today.
Thanks, you as well. So, folks, Richard is an expert in the infinite banking concept, and he helps people do that. He's been doing this since 2009. And he also has a podcast, Wealth Without Bay Street. And I'd love for you, Richard, to, I know this is such an incredible tool for investors to know about and really understand and harness as they begin their journey towards achieving financial freedom and building generational wealth, et cetera. Why don't you start us off by sharing a bit about your story and how and why you got into this space in the first place?
Yeah, I'd love to do that, and thanks for asking. I mean, it's kind of interesting how things show up in your life, a bit of a comedy of errors along the way. I was with my family. We purchased our first rental property when I was about 11, 12 years old. So I was on title as a beneficial interest to that property. And over the following 6 or 7 years, basically every tenant story that you've probably either heard of or experienced, we did that in that one property. It was an up down kind of duplex, like a suited property, and it was in the small town. I'm from a small town in called Camrose, Alberta, which is no one here would ever hear of, basically. But it required a lot of energy and work, and of course, we were early to the market. We know real estate's a long time thing, but we caught a kind of a very flat level market, so we didn't have a lot of appreciation over that time frame. But things I remember is reclaiming a yard from a dog named Goliath. Now, if you're picturing a dog named Goliath, that's basically what we're talking about here. Moving dozens of appliances on the tiniest stairwell known to man, lots of painting, drywall repair. We had some guys that were playing floor hockey in the basement, body checking each other through walls. So things that I learned, early on in my youth about property management was that it's not a lot of fun. And so I was pretty fed up with the whole thing when we sold that property. I said, I'm never doing this again. And literally 2, 3 months later, I was buying another property with my parents right after that, as soon as I turned 18. And because I'd learned that there was a way that you could have management, and you could deal with things in such a way where you didn't have to be as hands-on, and you could create, maybe you had to give up some cash flow, but you could create a little bit more of a passive environment. So that led me to the next one, and then to the next one.
And
And
how did
so,
that mindset shift? Because you said it was just a couple months before you decided
yeah,
to buy another
it,
property.
I think the difference was education and being exposed to some new knowledge, and growing up at that time from my life was very busy for me, not just because of this property, but my parents also owned a business. So I had our family business, which was, I would tell people, I was the heir to the portable toilet kingdom of Camrose, Alberta. So we had a portable toilets and a septic business, and so it was very busy. It was
Wow.
constantly running around.
Yeah.
And plus we had a large acreage, surrounded by farms. We grew up in a farming community. So there was animals, there was just constant stuff happening, and it was busy, busy, busy all the time. And it was basically work all the time. So all I really understood was you got to just put your nose down and work hard, and just keep going until you put your head on your pillow, essentially. So that was kind of how I grew up in that environment. So the property that we had, that first property, was actually it was like a distraction of effort and energy that I had a negative connotation with, because I didn't see how it was adding value to our life. All I saw was the work. Well, when we were done and we sold the property and I got a chunk of that paid out, which my parents didn't have to do. Of course, my mom compartmentalized things really well. So we each had my siblings and I each had our share of that property. Well, I took my share, and then we realized, hey, there's this other opportunity where we could go and invest in a condo conversion project. That condo conversion project, they're going to revamp the building. We're going to get it at this price. It's that turnover and an increased rents is going to increase the value in about a 2-3 year time frame. And then, over a long time, we'll have that paid for. I'll never need to see it. It's managed in our rental pool. I'm like, wow, this sounds pretty cool. I don't have to move an appliance. I don't have to see a tenant. I don't have to deal with none of that stuff. I don't have to paint any walls. I'm like, okay, all the things that I hated about the first property, I just solved all those problems. So yeah, within about 3 months, I was taking my share and I was reinvesting into the next deal. We had that property for about 3 years. We sold it. I got my first, I think, $20,000 check. Okay, great. I'm hooked. This sounds fantastic. That really led me down the path of learning and getting involved in coaching programs and real estate networking groups, and getting deeper into the real estate process. Then I started learning about private lending aspects that you can do, which is very popular down in the States. It's also popular here in Canada. And there's a way that you can do private lending on mortgages with government sponsored plans. So like 401ks, and in Canada we have RRSPs. It's kind of the equivalent. So there's a way that you can unlock their potential without taking them out of that account and become a private lender on title to a property. So I did some of that, and I thought that was fascinating. And I really got fascinated by mortgages, mortgage amortization specifically. When you see that mortgage and then you get a chance to look at this, a spreadsheet, and you do the numbers, it's like, wow, this is a racket. Like, this is just a total racket. Look at that first payment. How much of interest goes in that first payment to the lender? You never get to see it again. In theory, you get to see their principal as long as the real estate market goes up or it stays level. If the market goes down, you don't even get your principal back, if that makes sense. So, and by the way, I've experienced those things in my time. But the looking at that mortgage amortization, it just really captured me, and I couldn't get it out of my head. I actually went and bought this book, this little thin book. I don't know if they still sell it. And it was like a book on amortization where you could flip through the different interest rates and a volume and a certain starting loan amount, and it would show you, calculate the payments for you. And like, I would just like flip through that book and look at it every once in a while because I was just fascinated. So I knew fundamentally I needed to find a way where I could become the bank. This is a good business. They've got the right business. I want that. I don't want the property. I want what these guys have.
Yeah.
I want that cash flow. I want that control, because the bank looks at the deal. See, every liability is someone else's asset, and every asset is someone else's liability. When we look at the balance sheet of a bank, the liability is your deposit account. You put money on deposit. Well, that's an IOU for them. They owe you that money. They got to pay you a little bit of interest for you to be incentivized to keep it there.
Yeah.
And whereas if you go borrow for the mortgage and everything else, well, that's on their asset column. That's a cash flow machine for them.
Yeah.
And then they take that payment stream as it comes in, and because of the virtue of size and speed and technology, they can instantly go put that cash flow payment back to work again. They don't have to let it sit there and wait. So it's just a phenomenal business model. I'm like, well, why wouldn't everyone want to be in the banking business? Now, I knew that I wanted that. I didn't know how it was going to show up in my life, but my intention was kind of always there.
Interesting.
And then 2009 comes along, and this book, Becoming Your Own Banker, by my mentor, R. Nelson Nash, shows up in my life. A good friend who I had a side business with, that told me to go buy this book. I read that book, and at that time, I had left my electrical career. I'm a recovering electrician by trade, and I had transitioned to real estate. So I was a licensed realtor in my hometown for about 9 years, and I was making that transition when this book came into my life, and I'm like, oh my God, this is what I've been looking for. Like, this. I knew this information. I knew something was out there. There was something I was missing, and this is what I had been looking for my whole life. And I like to have like a steak dinner. So if you've ever gone for a great steak place or a great, night out and dinner with, the spouse and family, if you had a really good experience and the food was top notch, you're probably going to tell someone about it, right?
Yeah, for sure.
Me too. I'm not going to hide that. I'm like, oh, that's my restaurant. You can't go there. Like, you're going to share that with people.
Yeah.
Well, that's how I felt about this book. So once I got the information that Nelson Nash downloaded into my head, I realized I would not be in my own integrity if I wasn't sharing that message with other people. Because once you know it, it's kind of like the Matrix a little bit. Like, once you know it's out there, you can't unlearn that information. It's just not possible. So that started my mission and my journey of being able to find out, first off, can we do this in Canada? Which we can do it very, very well, actually. And then getting started on helping people understand how to implement that process. And so that's what I've dedicated my life to, really, for the last 13, 14 years. And it's been an amazing journey, and we've been having a ton of fun doing it. And we're impacting people all over North America now with this message. And so Nelson, who wrote the book, he became my friend and my mentor. I miss him dearly. He passed away in March of 2019. And one of the things that we did, my co-host of my podcast, Wealth Out Bay Street, Jason, and I, we actually helped facilitate a documentary film on Nelson. And people can go ahead and watch it. It's nelsonnashfilm.com, and it's publicly available. And it's only about an hour long, but he was a very inspiring individual, and he recognized core problems in the world and how certain fundamental principles could solve those. And you could solve them in your financial life at the you and me level, he would say. And by doing it at the you and me level, it would have a larger impact on the world as a whole. And he really felt that. And so that's really, in my opinion, the mission that I'm on, is to help support Nelson's initiative by having more people implement this in their life so that they can have a peaceful, stress-free way of financial life.
Yeah, for sure. Yeah, that's awesome. You touched on so many important pieces in your, intro there, and really cool just to hear how impactful, Nelson Nash, the man, was to you and to so many others, right? Um, so, and that's really cool that you facilitated a documentary on him. It's definitely something that I want to check out, and I think listeners would probably be another really great way to kind of learn more about the infinite banking space, in addition to, of course, talking to people like Richard. But yeah, so excited to dive into the details there. And I think it's really interesting that you kind of knew that banks had a good business model early on. Because I feel like when that information came to me, it was like I went to, something about wealth or something. And people were like, well, look at what banks do. This is the bank's model. But it hadn't really occurred to me until, that information was spoon fed for me. So that's really interesting. Yeah, and then I would love to now just hear, let's see. So we know a little bit about how and why you're passionate about this, and it makes a lot of sense, right? To like have this information that's can really change people's lives and change the entire trajectory of their financial futures. It's like that is such an important mission, right? To, if you feel connected to that mission, to spread that information and really help people access these financial tools that most people don't know about still, right? So yeah, so let's actually go ahead and start to dive into exactly what infinite banking is, what it means to be your own banker, and how that can help people change their financial trajectory.
Yeah, I'd love to do that. And it's, infinite banking is a concept. It is I actually think it's more of a way of life. It is something that you proactively do throughout your life. It's not a product, and it's not an investment. It's not an investment strategy. I think a lot of information out there gets people to maybe murky the waters a little bit, where that's the conception that people have, but that's not really accurate. Really, we all bank. Banking is a transactional nature of money moving from one party to another in a short period of time. Okay. We all have to do that. We've been doing it ever since we got our first bank account. So right now we work with a brick and mortar type bank or digital bank, and we do that to some degree, and we use their services to allow it to happen. But it all has to do with money movement. It's got to do with the flow of money. So infinite banking is taking that same model and mindset and thinking about how money comes into your life from earned income, whether it's passive income or earned income or active income. Money's coming in, and then money's got to go out. But as on the way out, it gets split up in all these categories. You got to go pay the mortgage guy, the car loan guy, you got to go pay the tax man, you got to go pay, for food and beverages and all these kind of things. So everything gets chunked up. In the process, there's only a little bit of money that's left over, your positive cash flow, that you get to keep and then do something with. Does that make sense? Mm-hmm. So that movement of money as it comes in and then goes out, that's a constant transfer of money away from you and away from your control. What we're able to start doing, and it doesn't happen overnight. This is a process. It's an education process that happens over time. But once you understand what infinite banking is about, you can start the process of harnessing a lot more of that capital as it's coming in before it goes out to all those other people. Mm-hmm. And then you can optimize that money so it can do more jobs for you for the rest of your natural life. So $1 now is working for you for the rest of time, or at least until an insured individual passes away, before it goes out to pay the mortgage guy and the tax man and everything else. And I'll give you a quick example of that. So last year, I have quite a number of policies. The vehicle, the tool that we use to help implement this process effectively, the most efficient vehicle, is a very well-structured, high cash value, dividend-paying, participating whole life insurance contract. Now that sounds pretty boring, and the reality is it kind of is, and that's great. It's not meant to be crazy exciting. It's meant to be functional. Yeah. When we want a banking system in your life, you're not trying to knock it out of the park like your real estate deal. All you want is something that is functional for the purpose that we're trying to get it to work for, if that makes any sense. So I set up one of these here about a year ago for my wife. I have a number of them already. I have 2 kids. I have 2 policies on each of my children. I have a number on myself. And the one I did on my wife, I designed it because I wanted to harness money that I set aside every time I earn income. I put a percentage away to pay the tax man. Okay. So Uncle Sam for you guys and Uncle Trudeau for us. All right. So we got to pay the tax man. I set a percentage of that aside. I'm going to do that like clockwork. I've got that habit down pat. That's building up an account. Well, that account's in someone else's bank. That's not where I want the money residing. I want it residing with an entity that I co-own, which is the insurance company. So I started the process of setting up a new policy on my wife. Turns out that I designed it to be about $35,000 a year in annual deposit room. Does that make sense? So that's how much I wanted to deposit into this particular plan. There's some fine tuning that happens there. The minimum required amount, I'll just keep the math simple, is about 10,000. It's a little less than that, but let's just say it's 10,000. And the flexible portion, that is an optional amount I can chunk in whenever I want in the policy year, is about 25,000. Okay. So it has a lot of flexibility, a lot of potential, and I made the design. I'm the one that chose what I wanted to do as the policy owner. Okay. Now I put the 35 in, and I had to pay a tax bill that upcoming year. And I was able to access about 23 to 25,000 of that amount to go pay the tax man. Now, was that every dollar I needed to pay in tax? It wasn't, but it was a pretty good chunk for my corporation. I had extra money set aside to make up the difference. But the $35,000 that I put in, that's now working for me and my family for the rest of my wife's natural life. It can't be stopped. It's in perpetual motion until the day that she's no longer with us. She graduates. So when I made that transaction, another thing happened. And this actually is part of what we describe. And it's the topic of our second book, Cash Follows the Leader. As soon as I put that flexible portion in, the $25,000 chunk, it instantly purchased a huge block of paid up death benefit. Okay, Richard, well, that's really cool. Why would I care about that? I don't care about the death benefit. Well, here's the reason why. That increased chunk was about $110,000, which means I traded $25,000 of today's money for a guaranteed outcome of $110,000 of constantly accumulating money.
Okay.
Does that make sense?
Not quite. Can you repeat that?
Absolutely. So I have an option to put in extra capital into the policy up to the $35,000 limit. The amount that's flexible was about 25,000. So 10 was the minimum, 25 was a flexible portion. As soon as I put the 25 in, it instantaneously purchased what is called a paid up addition.
Okay.
In other words, it's an addition to the policy that's fully paid for. Just like we buy your groceries and you leave, those groceries are paid up, right?
Yeah.
Well, I paid up this death benefit. It turns out the amount based on my wife's age and her health status was about 110,000.
Okay.
Now, in Canada, by age 100, the cash must grow to equal the death benefit. In the US, it's age 121. They've made a shift there a couple of years back. So that means every single day that my wife puts her head on the pillow and wakes up the next day, the insurance company is contractually obligated to increase the amount of cash asset that is in that pile until it reaches the 110,000. Does that make sense?
Yeah.
So I traded 25,000 of today's money for 110 of guaranteed accumulating money.
Okay.
It's a pretty good way to keep up with inflation, isn't it?
Yeah, for sure. But of course, you get that only when she passes.
Yes and no.
Okay.
I get it when she passes, if she passes immediately. So it's already contractually required that they have to pay it out. But if the capital is increasing the whole time, I can access whatever that capital increase is. So think about a house. Think about equity in a house. One of the reasons people invest in real estate is for cash flow, for mortgage pay down, like principal pay down, and appreciation. Well, principal pay down and appreciation, that just adds up to equity. It's the jelly in the sandwich. Okay. Yeah. So what's beautiful about equity, okay, it goes to your net worth, it increases your net worth, but it's difficult to spend equity. The only ways that you can unlock equity in a home is to sell the house or to go and refinance it with someone else's money. Does that make sense?
Yeah, absolutely.
Well, you've been in the real estate game for a while. You know all about, multifamilies and accessing someone else's money.
Yep.
And if you want to access someone else's pile of money, they won't let you have it for free, will they?
No. Yeah. Okay.
They have no sense of humor about it at all, right?
Of
So
course not. Yeah.
you got to jump through a whole list of hoops in order to be able to access their pile, because you have to demonstrate you're a good borrower and you can make the payments. Well, with the insurance company, you can access equity just like you can in a house. The difference is there's no restrictions, there's no requirements, there's no questions, total control, and I get to dictate the repayment terms of how I put the money back in.
Okay, so let me see if I understand. So let's say you end up putting in that 10,000 plus the additional 25,000. So now you have this paid up benefit. So tomorrow, can you borrow against that death benefit?
Almost. I could borrow against the cash asset, which is the equity, which
Which
is
is that 35,000?
a representation of the future death benefit.
Okay, so that's the part that increases over time.
Correct.
Okay.
And so that cash has to continue growing every day to reach that target. It has to reach the original death benefit plus any of those increasing portions that I add up as I go through time.
Okay. So when you say the cash has to increase, you mean you have to keep putting in money, or the policy is increasing? Yeah. Can you explain that part?
Yeah, great question. So think of it this way. Did you ever play Follow the Leader when you were a kid?
Yeah.
Okay. Or tag is kind of similar. Well, follow the leader, you're literally following the leader. Well, the cash value, which is the asset portion or the equity of an insurance contract, it is playing follow the leader with the death benefit. The death benefit is the leader, and as the leader, the death benefit increases and increases and increases. The cash value has to chase after it. The higher and bigger we increase the death benefit, the faster the cash value's got to run.
Okay.
So every time it leapfrogs ahead, the insurance company is obligated to add cash value to your contract immediately. So it begins the process instantly. And then as that happens, your share of ownership of the insurance company's money pool goes up, which means they have to return profits to you each and every year because
Okay,
you're
let's
a
just back up
co-owner.
for a second because I want to make sure I understand and the listeners understand too. So the death benefit is over here, and it's the cash benefit is following it, right? And catching up to it. So what is causing the death benefit to increase? And what is causing the cash value to increase?
Great questions. So what's causing the death benefit to increase is two components. Component number one is the voluntary decision of the policy owner to put in the extra capital. Okay. As soon as I put in that extra capital, it's called a paid up additions rider. When I put that in, it instantly creates a massive chunk of new death benefit, much greater than the dollar I put in. Okay. Second question is, what's causing the cash to grow? Well, because I increased the death benefit, the cash automatically has to grow to chase after that new increase.
Okay.
So the insurance company is shoving the money in there because they know at some future point they have to do what? They're going to have to pay a
death benefit.
You got it. And because they have to pay it, they have to make sure they have the money in there to do it. That's what the cash value represents. So the cash value is the present value of a future death benefit.
Okay.
And every day that you age, it has to increase. So that particular contract to my wife, just as an example, again, I had a purpose for that I was running money to setting aside to pay the tax man. Rather than giving to the tax man directly and saying goodbye to the 35,000 forever, I chose to put the 35,000 into a system that I own and control, which increases protection for my family because I needed the coverage anyway. And it increases my financial control for every future day for the rest of my life. I was able to access money by what's called a policy loan, which is, think of it like a home equity line of credit. It's no different than using a home equity line of credit, except instead of it being tied to the title of a property, it's tied to a policy number. It's the only difference. And I went and paid the tax man the money that they needed. Now I have an outstanding line of credit against my policy, but I still have to save money for next year's tax bill. I've already repaid that policy loan because of my income, and I'm ready to go do and duplicate that process again. And each and every single day, that one contract is getting more and more efficient. It's kind of like, if you think about a long-term buy and hold piece of real estate, you're going to go put, let's say, 20% down to acquire that piece of real estate. Well, you have to come up with a whole bunch of down payment. Well, once you buy that property, do you have access to all that down payment immediately the next day?
No.
No. That property, you got to pay down some mortgage, you got to increase rent and revenues, you increase cash flow. Hopefully there's some appreciation. In a typical, very plain vanilla deal, long-term buy and hold, single family house, you're probably waiting somewhere between 5 and 7 years before you have access to the equivalent amount of money you put in the down payment. Is that a fair assessment?
Yeah. Mm-hmm.
Well, it's about the same in an insurance contract. The difference is that the appreciation is guaranteed to grow, and you have total access over the usage of the money before you even get to that point.
Okay, so here's another question. So there's the $110,000 death benefit, and then there's the $35,000 that you put in year one. So in year two, if you put in another $35,000, does the death benefit go up?
Coincidentally, I just did that about a little less than 30 days ago, and I had a massive increase in death benefit, and I had a massive increase in cash value that followed.
Okay, so how much did the cash, like, let's just use this example. If you put in year two another $35,000 in, then how much is the new death benefit? I mean, you might not know exactly, but just like approximately.
But ballpark, it went up about another 110 grand.
Okay. And then the cash, so let's say in year one, the cash value, what was the cash value that you could, like, borrow or take out? And then year two versus year two.
When I first set up the contract, so the first day, I was able to access approximately 24,000. I don't remember the exact number, but it was something like that.
Okay.
And then throughout the rest of the year, the policy kept accumulating. So by the time I got to the end of the year, there might have been another $3,000, $4,000, $5,000 in there. I don't remember the exact amount.
Okay.
Now I've funded premium year two. How much do you think I put in?
35,000.
35, because that's what I wanted to do. Nobody made me do it. I only needed to pay 10. It's actually lower than that, but 10, and I chose to do 35 because that's what I want to do. Now I can access, I don't remember the number offhand, but I know that it's about 70% of every dollar that I've contributed.
Okay. Yeah. Okay, great. But that, you said that that's also growing based on the time, right? So up to 70%.
And the policy is only in month 13. So over the rest of the year, it's going to continue accumulating. So by the time I get to the end of the year, I'll probably be closer to 80% of what I can access of every dollar I've put in.
Okay.
Now, then year three happens. Well, it's going to get even more efficient. And then year four happens and it'll get even more efficient. Yeah. So by the time I'm out to year 5 or 6, actually from this one, it's a pretty good policy. Probably by the end of year 5, maybe early year 6, I'll have access to 100% of every dollar I've contributed. And the insurance company is now paying me to own that contract.
Okay. What are they paying you?
Well, I mean that not so much in technical current terms. I mean that if I put $1 in and that same year the policy grows $1.10, or it grows $1.20.
Yeah.
If you had a bank account that did that, how often would you put the $1 in?
As often as possible, obviously.
As often as possible. And if you knew that each and every year that you did that, it got better and better and better because of an engineered outcome, would you ever stop putting the $1 in?
No.
So that goes to page 85 of Nelson's book, Becoming Your Own Banker. Mm-hmm. On point number 2 on page 85, Nelson says, if you knew at passive income time, you would be getting back every single dollar that you put into a system, potentially tax-free, would you ever object to putting any more money into it?
No, of course not. Okay, wait. So this is great. You're very good at explaining this in a detailed way. I've had a lot of folks on it, but I think, you're really good at this. So let's say, so it sounds like after about 5 or 6 years, if you do things a certain way, that's when you can access 100% of the cash value, right?
It varies based on a variety of factors. Things like it can vary on age and a whole number of factors. In this particular case, like again, if the policy was a smaller, like there's an expression, if you put pennies in, you get access to pennies. If you put dollars in, you get access to dollars. So there's some economies of scale. It's kind of like when you buy a multifamily unit versus a single family unit, there's certain advantages you get for taking the jump to multifamily, right? Higher cash flow, et cetera. Well, with insurance, there's some similarities there in that it's kind of like Costco. You ever shopped at Costco?
Yes.
Well, the reason people have a Costco membership is because they can get better value per unit on their purchasing power. The same thing can apply in the insurance realm with good coaching and strategy, with someone who understands the mechanics of that to help build and design something and then coach you through the utilization of it. So, that $35,000 policy, there's some reasons that it was a certain size. It actually had to do with the fact that I had a term insurance on my wife already on another policy, and I converted that term insurance into this new contract. So that was, giving you another idea of options that are available. The word options is really important, and real estate investors understand options because you can do options in real estate. You can go and pay a certain amount of money to have the option be the first person to access or purchase that property for a certain price. The same idea applies to insurance. Term insurance is basically like an option on tomorrow. I'm pre-approved for a certain amount of death benefit. That's an option for me to go turn on another banking system when I'm ready, when I'm good and ready and I have the cash flow to do it.
Okay, so I heard that of other folks who have like multiple of these policies. One question I have is, why would you have multiple if the policies get more and more efficient over time? Like, wouldn't you just keep adding to the same policy?
Great question. So yeah, that's actually a super phenomenal question. And this is really, really important. So a policy is an insurance contract, and there's rules and regulations in US and in Canada that there's only so much capital that an insurance policy is allowed to accumulate so that it maintains being a tax exempt policy. Tax exempt meaning it grows tax free, it accumulates that way, because the purpose of the policy is to pay a death claim. It's there to support the loss of income for somebody. That's really its primary function. So there's some limitations on how much capital can accumulate. And if you put too much in, well, then it's no longer an insurance contract. It's now an investment of some kind. The vehicle changes and then the tax treatment changes. So there's limitations on how much you can shove into a policy over a certain period of time. That's an important requirement. The same in US and Canada. The way that's done is a little bit differently, but it's effectively the same. So this $35,000 contract, that's the cap. That's the maximum. I couldn't put another dollar into it if I tried. So when I'm ready to increase my system, I need to go and I need to have another place to deposit. So it's really a way to look at it is like, why would you go buy, if real estate's so good and you bought your first single family piece of real estate, why would you go get another one?
Okay. Yeah.
If it's working really well and the cash
because
flow is good and it's
want
growing,
you want more passive income, but you have to get another house to get more passive income or whatever it is. Yeah, no, that makes sense. Now it makes sense. You can't put in more than 35,000. So, okay, cool. And another question is about the tax. So you got to put money into this post-tax. Is that right?
That's correct. Yep.
Okay. So you put post-tax money in, but then, I know, you and others talk about the tax benefit. But then that money is growing tax-free. Can you explain that a little more?
Yeah. So again, following my cash flow as a leader example, that capital is accumulating because it's chasing the future death benefit. It has to grow to equal that death benefit, which means it's not hingent on the next federal election. It's not hingent on what the stock market's doing or interest rates or any of those things. It's growing based on a contractual element, and the insurance company is bound to abide by that contractual element. So you've kind of got them on the hook, if that makes sense.
Yeah.
So that capital that's accumulating, it's accumulating in a tax exempt contract, which means there's no taxation on the growth. Now, there's ways that you can access that capital on a tax-free basis, both in US and in Canada. The way that it's done might be a little bit different, but fundamentally you can access through the power of collateralization. It's kind of like if you own a multifamily building or a single family house that's paid for. Well, if you go get a home equity line or you refinance that and you get a deposit into your bank account from the loan funds, do you have to report that as taxable income?
No.
Exact same scenario.
Yeah.
The only difference is it's an insurance contract instead of a piece of real estate.
Right. So you get to access the capital tax-free. And then as it's growing, you also don't have to pay. I guess you wouldn't pay taxes on the death benefit when the death benefit is issued, but whatever the cash value is, you just don't have to pay tax on it because it's like you're drawing money out of your loan.
And the reason is, a way to look at this is, when I take a policy loan, I'm basically, I'll again use my wife's policy as an example. I'm taking an advance on a future death benefit. Mm-hmm. So if I have an outstanding loan of $50,000 and some interest accrues to the life company, I don't really care because I co-own the life company.
Mm-hmm.
Okay. So as a participating owner, I co-own that company with all the other people that co-own it, and they're going to charge interest because they're putting that interest to work for all of us. It's a closed ecosystem. It's like an aquarium. Well, if my wife passes away, the total death benefit on that contract, I think is, well, it's already over $1 million. It's probably $1.2 million or something. Let's just say, well, 1.2 is going to come in, and the $50,000 loan plus a little bit of interest is going to get paid back to the life company. The net comes to me tax-free. Did I get all my money back?
Yeah, and a lot more,
Okay.
for sure.
And then so as that grows and accumulates, well, my plan and my intention will be I'm going to spend, my wife and I are going to spend or use most of that cash as it accumulates
Oh, right.
to buy assets like real estate,
Yeah.
invest in cash flowing businesses, and do things like help put our kids through colleges. I need to drive a car for my family. We have a minivan. Okay. My kids are 5 and 7,
So then you guys are,
and cycle the money back through a system that we own and control.
yeah. So you're taking the debt, you're taking the cash value, you're investing it in cash for to fund your life and in other investments that are producing income. And then you're also paying interest, right, to the policy.
To the insurance company that I co-own.
Right. Yes. So I think we haven't touched on that yet. So like you said, you set the terms, like how much insurance is it? And does that, why would you decide to pay less or more interest to yourself?
Yeah. So very good question. So the way to understand this, first off, is important to understand what an unstructured loan is. Most people are familiar with loans, but they're only familiar with structured loans. A structured loan is what a banker gives you. It says it has a term, a payment, an amortization, etc. And the banker is the one who always makes the decision on those features. Well, if you're the banker, you get to decide those things. With the insurance company, the ability to access a policy loan is a contractual right as the policy owner. So that gives you the hammer, that gives you control. The loan repayment terms are completely up to you. The insurance company doesn't ask for a repayment. If you don't send any dollars back in, some interest will accrue. That interest accrues to the life company, which you co-own. So you have to be a good steward of this process and understand how to make it work for you. Otherwise, you could end up with negative consequences. So you have to understand how loan repayments work, and you have to be in the position to understand. I'll put it this way. If I had money in a savings account and I built up $50,000 in a savings account, the moment I take that money out of that savings account and I put it as a down payment on a property, how much is left in my savings account?
Zero.
Zero.
Yeah.
Now, and whether I bought a down payment on a property or I put it on I bought a minivan, if the minivan's going to depreciate, so there's no asset value there.
Right.
Hopefully the real estate's going to appreciate. I got an asset value, but I have to rebuild my savings account to do the next deal, don't I?
Yeah.
So I have to set money aside. I got to put it aside on a regular basis. If I don't do it on a regular basis, there's no more money there.
Yeah.
Well, that's a payment.
Yeah.
It's a payment into a savings account, but it's still a payment. Well, if I take 50,000 as a policy loan, my 50,000 is still growing in the policy. It never left. The policy was simply collateral. My money doesn't come out of the contract. My money continues to grow in the contract. The insurance company issues me a policy loan from their pool of money. And if I make repayments to that, isn't that any different than me rebuilding my savings account?
Yeah, I see what you're saying. So, your policy is growing, you're paying some interest on it. So that's fine. And then at the same time, the cash value is growing day by day. Every
Correct.
single day it's growing, which is, I think that's kind of like why this is so cool, and why, it hasn't actually I haven't actually fully hit on this. It's like kind of like compounding interest. Like once you understand the power of compounding interest, it's like this amazing tool that you can harness. And, if you really grasp it, you like want to really use it. And so it seems like that's kind of like, but it takes time, right? It doesn't just happen immediately.
I have an awesome thing to share about that. I'm really glad you brought that up. You're right. It has to do with compound interest. And here's the thing. In order for compounding to work, it can only work where money sits still. So if you're earning an interest-bearing account, well, that money has to stay there in order to earn it. As soon as you deplete or take the money out, that earning potential is gone forever. It's a permanent transfer of earning potential. So most other financial vehicles that we do, 401k or this or that, or an IRA or whatever the tool is, you put the money in there, it can only do the job of one. And if you want to change it or move it someplace else, you have to take it out of there so it's not earning, and you got to move it someplace else. If you need to go and pay off your mortgage or go buy a vehicle because you need one, and you collapse that account and you go buy a vehicle, all the money is in the vehicle. You can only do the job of one. When you insert the insurance contract in the middle, now you're doing the job of two, actually the job of three if you do it effectively. So my money is in the insurance contract and it is constantly growing. It will always accumulate it because it cannot be stopped. The only thing that stops it is a non-payment of premium or somebody kicks the bucket. Those are the only two things that can stop it. So that money is now in constant motion. It is uninterrupted. And by accessing capital using the power of collateral, I can take the equivalent or a similar amount of money and I can still go do the thing I was going to do anyway. So now I have money operating in two places at once, and it's all protected by a giant wrapper of tax-free death benefit.
Yeah, very cool. Awesome. Well, this has been very informative, Richard. Thank you so much for taking the time. We got to wrap up. Please share with the listeners how they can learn more about you and get in touch.
Absolutely. Well, we have our podcast, Wealth Without Bay Street, and a great thing for people to do to learn a little bit more about this and understand the steps of learning. We have an amazing report. It's totally free at 7steps.ca. That's 7steps.ca. It'll walk you through the exact learning journey that we recommend people take to determine and understand, is this even something that's a fit for you or not? Because if it's not, that's cool. But if it is, you're probably going to want to know about it.
Yeah, sounds good. Sounds like a great resource. And we'll make sure that's in the show notes. Thank you so much, Richard, for coming on the show, and so much great information. And we'll see you next time.
Awesome. Thank you.